All right, welcome everybody. Today is Friday, March 21st, 2025. This is You've Got Options for Income Navigator, and we're going to start off with a daily chart of ES. This is E-mini S&P 500 futures. And we can see after this, what was about a 10% decline. This was last Friday. This is today. The market is trying to get out of a hole. We are barely coming up on 38.2 Fibonacci retracement level. We have 2 days. This is Wednesday, right after the Fed. We had a move up, couldn't hold higher levels, pulled back into the close. Thursday was kind of a inside day, not here, not there, so kind of an indecision. This morning, market was weak. We're way off the lows today, which is not a terrible thing, because we're not rolling over and selling off. We still have an hour before the close, but the fact that we're not rolling over on the Friday, and today also is a pretty big expiration. I think $4.5 trillion worth of notional of options expiring today. So I was expecting a little bit more shenanigans, but if this is all we're going to get, it's all good with me. We can see that we're way off the lows today. We are now just barely, and this is on a daily time frame, we are just a hairline over 8 EMA. We are below 21 EMA, and we are below 200 day simple moving average. We're also below that 38.2, which is the first line in the sand for me. And I'm kind of, the reason why I put these Fibonacci retracement levels is to give an idea, or to show me, what is the price going to do? What is the reaction going to be like around those levels? Also, there you may notice there's some very thin lines here, and we need to scroll or zoom out and go to the left to get a better idea of what these lines represent. We are currently sitting at around levels which I thought were going to be potential levels of support on the way down, right? And we talked about when the market is selling off pretty fast and when volatility is relatively high, right? The market gets a lot of, there's a lot of emotion flying. So the market doesn't really care about support and resistance. When they're all selling and the market feels like the sky is falling, very often we're going to overshoot any reasonable level of support. And when we get these counter trend rallies, sometimes we blow through levels which technically supposed to act as resistance. So the level at around, and this is where we are right now, so about 57.30 or so on ES. This is the level going back to last year, early in November, which was a support level from November. This is right before the election. And then right before then, this was going back to the beginning of October, which also was a level of support, right? So we held this level twice before we found buyers, and we essentially ran into end of the year, and then eventually made our way to all-time highs. So on the way down, first line in the sand for me was, again, another support level that did not hold. And then we came down. I was looking for the next line in the sand, which was the lows from October and November of last year. That did not hold. Essentially, we came down, and if you want to look for some, and this will require you to put on your tinfoil hat, but if you want to look at some Fibonacci voodoo, you can look at a retracement levels going back to August low to most recent all-time high, and we stopped almost on the dime at 61.8 retracement level. If you connect the low of August 5th to the most recent all-time high. Was this a coincidence? I don't know, but once again, the 61.8 Fibonacci number came into play and kind of saved the day for now. Right, so now we are bouncing. We're looking for first potential resistance at around 38.2. Then the next level we're looking is about a halfway back, right? And what are we measuring here? We're measuring the distance between all-time high and the most recent low, which was last week on Thursday. Halfway back would be at around 58.38. And what a coincidence. This halfway back level also coincides with or around the level where I thought we were going to see some support. So if the market is grinding higher, I think this is a pretty good level to assume that we're going to expect some resistance to come into play. But before all that, we need to still get above at least 21 EMA, 38.2 Fibonacci retracement. There's also a 200-day simple moving average. So there's a lot of resistance up above, right? So that makes me say that, we are nowhere near to be out of the woods just yet, just because, we had this week, we see the market kind of rebounding a little bit. And today, being a Friday, the market's not rolling over. Yes, those are positive, but we still don't know what's going to happen going forward. And we definitely need to be um, careful about, putting ourselves in a position that could potentially come back and backfire on us. You want to talk about volatility? We can look at the VIX, right? The VIX, we're not anywhere near to where we were, right? And if you're looking at the chart of VIX, we can look for, we can draw a couple of lines to kind of give us an idea of where is the lower end of the range and where is the high or the higher end of that range. So, right, ever since or after the August 5th volatility event, right, the VIX has been in this range where, you can say that 23, maybe 24 is the higher end of the range. And then we come down, you know, about 14 and a half, and we were down as low as um, this is 12 and a half, and I think that's way too low. So maybe we could just bump this up a little bit and say that, if we get into anything with a 13 handle on the VIX, that's low, relatively speaking. Anything in the 20s, mid 20s, that's on the high end. So right now, the VIX is, the fact that we're under 20 is a good thing. I think anytime market or the VIX gets above 20 and market becomes a lot more emotional and more sensitive. And also, we talked about this already, and you guys should be able to figure out if the VIX is at 20, what is the 1 day expected move up or down? I think the answer is 1.25%. So if the market is implying about a 1.25% up or down on any given day, the market is going to become a little bit more sensitive. And as the volatility continues to rise, and we go from 21 to 22 to 25 to 27, right? The higher we go, the bigger the range is on a day-to-day basis. The swings are much bigger, and we become a lot more emotional. And that's just how this works. So right now we're under 20, which is, I think, a good thing. And we're, working our way back down into the teens. I think if we get to around 18 to 17, things will settle in, market will become a lot more stable. And if we are expecting some kind of a rally, I think it's more likely to come from much lower VIX levels. I could be wrong, right? Again, I said that, counter trend rallies in a bear market are just as fast and furious as those moves on the way down. So I'm not making the case that we are in a bear market right now, even though we are below the 200 SMA. But this may be a counter trend move, and the only time we can, make an educated guess if we are in a bear market, if we are going to rally, make a lower high relative to most recent all-time high, and then take out this most recent swing low. Yes, I think the trend right now, short-term trend is down. And if we are going to establish a lower high and then potentially make a lower low, we can say that the trend is longer-term trend is now down. Maybe we are entering a bear market. Going back to the VIX, we'll look at the VIX, and VIX under 20 is a good thing. Things are starting to become a little bit more stable. We talked about VVIX, which is the VIX of VIX. And you can see this also has a range, right? Anytime VVIX, which is volatility for volatility, this tells us about the demand for VIX options. This tells us about what market is anticipating as far as volatility for VIX itself, right? It's on the lower end of the range. So we can say that the market right now is not anticipating that the volatility or the VIX is going to move around a whole lot, right? So we have to assume that for as long as VVIX stays down, the VIX is probably going to come down as well. But the VIX isn't necessarily driven by VVIX. VIX is driven by the demand for S&P 500 options. So it's kind of, it's all interconnected, and it's kind of hard to tell, who's in the driver's seat. But for as long as VVIX stays low, the market is not really anticipating big swings in the VIX itself, right? And you know what? There's probably nothing wrong with, even if the VIX is going to stay, at around, somewhere between 18 and 21, right? But for as long as VVIX stays low, this tells me that the market is accepting the fact that we're going to be in a quote unquote higher volatility environment, right? That the market's not going to crash, but the market volatility, day-to-day swings are going to stay relatively high, right? That's what VIX at 20 represents. But as long as VVIX stays low, this tells me that the market is not anticipating VIX going from 20 to 50, right? So the market is not anticipating some kind of a major event for volatility or a major crash. So I think this is more bullish than bearish. We'll keep an eye on that and see how this plays out. And then, I'll look at these charts and I'll post, what I'm seeing. And if things are changing, I'll share my thoughts. Again, I may be wrong. If I'm wrong, I'll try to, explain why what I thought was wrong. And we'll just kind of have to go day by day.